PMIs, payrolls and oil prices. Investors have reasons to be cautious. Welcome to Market Insight. I'm David Pollard. Growth in Germany's services slowed for a fourth consecutive month in September, coming to a near standstill according to the latest PMI data today. And Eurozone business overall contracted. But at the very least, policymakers are making dovish noises. The ECB's top policy hawk, Isabel Schnabel, says inflation is likely to ease back to a target 2%. And Bank of England Governor Andrew Bailey says the central bank could get a bit more activist in cutting rates, though does see concern over the direction of oil prices. Well, I'm joined now by Joachim Klement, Head of Strategy at Panmure Liberum. Welcome, Joachim. Eurozone bond yields were at multi-month lows this week, but were easing up today. That's a bit of a surprise, isn't it, given the weak PMI data out of the Eurozone? Or is inflation still possibly proving a bit sticky, given a bit of a jump in August producer prices?
We think that the risks in headline inflation are clearly skewed to the upside, especially in Europe, but also in the UK and to a lesser degree in the US. We are now likely over the next 3 to 6 months going to see higher energy inflation simply because we're starting to compare winter oil prices with relatively low prices a year ago. And that also poses a challenge for the ECB. If they want to cut interest rates more aggressively and more frequently, well, then they have to make an argument why they can do that while Eurozone inflation is above 3%.
On the ECB, we have witnessed quite a pivot from Isabel Schnabel, hitherto known for her conservative stance on monetary policy. What do you make of her comments and how significant are they?
I think they're quite significant because, as you said, she is the most hawkish member of the Policy Decision Committee. And she basically paved the ground for a 25 basis point cut every meeting rather than once every quarter. As I said, the real challenge that comes from that is how do you defend such a more dynamic move in the face of potentially rising headline inflation?
Well, for his part, Andrew Bailey of the Bank of England triggered sterling's biggest fall in almost 2 years against the euro, with talk of being more activist on rate cuts. What's your guess on what's prompted that talk?
Well, I think there is, again, a similar motivation as we've seen with the ECB. Leading indicators for the economy have softened, much less so in the UK than in the Eurozone, but still there are challenges appearing on the sustainability of economic growth. And the central bankers just want to be able to cut more aggressively and prepare the market for such a possibility should we continue to see weak growth data.
But Bailey did concede some worries on the outlook for oil prices, generating inflationary pressures as the Middle East crisis worstens. Have global asset markets, do you think they've got a proper handle on the risks associated with the Middle East?
We think that the risks in the Middle East are limited, very limited, to be honest. And it seems to us very unlikely that we're getting into a situation where the Iranian oil supply, for example, is disrupted in a material way. So I think the market's got it a bit roughly right, approximately right, in being what looks almost like complacency with very low increases in oil prices.
So where does that all leave the US economy then, which is obviously more insulated to oil price shocks than the Eurozone? Is the big fear there a shock for the Fed in Friday's non-farm payrolls numbers?
Well, the financial markets are incredibly sensitive at the moment to job data in the US. And that sensitivity likely has increased after the last Fed meeting when the Fed explicitly said that they worry about softness in the job market. So if we are going to see weak job data on Friday in the non-farm payrolls, that will likely trigger another kind of rout in markets and more rate cuts being priced in. On the good news side, ADP jobs numbers were stronger than expected, so markets at the moment are preparing for relatively solid job market data on Friday.
And finally, there is still a lot of uncertainty ahead for the US markets. We've got earnings season coming up. Obviously, we have the US presidential election. Where do you see Wall Street going over the next few months?
That is a really, really tricky question. I think that Wall Street is likely to be in a holding pattern until the election is over. We know that businesses are increasingly in a holding pattern with their investment decisions. The only thing that could derail a kind of choppy sideways market over the next couple of weeks is major earnings disappointments by some of the index heavyweights. We clearly have seen in Q2 numbers that the growth in the tech space is slowing down. And the question for the next quarterly earnings will be, is that a trend that continues? And if so, is it accelerating or is it just kind of contained slowdown?
Okay, Joachim Klement of Panmure Liberum, many thanks for sharing your thoughts with us today. That is your Market Insight. We have more videos on Reuters.com.